Hello, legends. Bear Bro Hodelstein here from the team at CryptoTaxAudit, rocking my Santa hat because nothing says holiday cheer like talking taxes. And no, before you ask, I'm not handing out refunds from my moon bags. Mac hodls off on his Christmas vacation, and let's be real, you were probably hoping us bears would call it a season and hibernate already. Honestly, same here. I mean, isn't it time to release the bulls so I can have a well-earned nap? Before we kick things off, can we have a moment of silence for Wednesday's FOMC meeting? The Fed actually lowered rates, but instead of mooning, the market took a nosedive into a deep sea of red. Classic. I mean, my portfolio balance looked like a ski slope after that meeting. And honestly, it's got me wondering, do you reckon the three ghosts of Christmas might pop by Powell's place, give him a proper scare, and sort out this Scrooge-like mess he's made of the market? But you know what? I'm delighted. It's like an early Christmas present of cheap sats. Buy the dip and gift yourself some future gains. Enough market drama? Let's get to the real alpha. Today, we're talking about a major shakeup in crypto tax reporting, FIFO by account. I'm here to break it down and help you understand what's happening. But first, 2 quick steps to keep your crypto taxes in check, because the only thing that should complicate it is explaining memes to your grandma at Christmas dinner, not your crypto tax prep. 1. Get your safe harbor plan. Think of it as your tax safety net. Head over to CryptoTaxAudit.com/1099 and download your safe harbor allocation plan today. Don't wait. This one's a no-brainer. 2. Save the date, December 27th. We're hosting a live Q&A with our founder, Clinton Donnelly, and Ben, our Director of Crypto Analysis. They'll walk you through the safe harbor plan and answer your burning questions. Hit the link in the description to register now. If you need personalized help or tax advice, head over to CryptoTaxAudit.com. The link is in the description below. If you're trading, staking, or just diamond handing your crypto, you need to hear this. And stick around. I'll also tackle some of the juiciest questions we're getting from traders and investors like you. So, grab your snacks or your tax docs, and let's get started. All right, let's break this down. Have you ever heard of FIFO, or first in, first out by account, and wondered what the heck that means? Don't worry, you're not alone. FIFO stands for first in, first out, but when you add by account into the mix, it gets a bit more specific. Let's talk about how this works, especially in the context of crypto and taxes, and why it might be a game changer for organizing your transactions. Ready? FIFO, by account, is the IRS's new rule for calculating crypto gains and losses. Here's what it means. When you sell a coin, the cost basis for that coin must come from the same account or wallet where it was held. This is a big change. Before, many traders used the universal method where you could pool all your wallets together and pick the most tax-advantaged coin to sell, like the one with the smallest gain or biggest loss. But now, the IRS says no cherry-picking. FIFO by account treats each account or wallet separately, and it's mandatory starting with 2025 returns. Let me break this down with a quick example. Account A, Coinbase. 1 Bitcoin bought in 2018 for $10,000. Account B, Binance. First, we're only talking about account A here. Imagine this. You sold some Bitcoin and got $30,000. That's your sale proceeds. Now, the Bitcoin you sold originally cost you $10,000 when you bought it on Coinbase. That's your cost basis. So, When you subtract that $10,000 cost from the $30,000 you made in the sale, you end up with $20,000. That $20,000 is your capital gain, the profit you made. See what happened there? Even though Binance had a BTC with a higher cost basis, $15,000, it's irrelevant because FIFO by account treats Coinbase and Binance as two separate worlds. Here's why this is huge. Number one, and this is a big one, higher taxes on past returns. If you used the universal method in the past, the IRS could recalculate your gains using FIFO by account during an audit. And guess what? That could mean you owe more taxes, penalties, and interest. Number two, the IRS is watching closely. New broker-dealer rules are coming, and they're not messing around. Starting in 2025, brokers like Coinbase, Kraken, and Binance will report your sales to the IRS. They won't include your cost basis until 2026, but you still need to follow FIFO by account rules now to stay compliant. All right, before we get into the questions sent in from viewers, let's get real for a second. The absolute best way to protect yourself from these new IRS rules is by adopting a safe harbor allocation plan. What's that? Glad you asked. A safe harbor allocation plan is like a Kevlar vest for your crypto taxes. It makes sure you're not overpaying taxes, facing penalties, or being blindsided by the IRS's new FIFO by account rules. And the best part? CryptoTaxAudit has a free safe harbor plan that's totally IRS compliant. Yup, free. No strings attached. What's the deal? It's a signed, date-stamped plan that proves you've got your bases covered if the IRS comes knocking. It simplifies 2025 tax reporting by locking in your starting values now, so you're not scrambling later. Keeps the IRS from slapping you with penalties for missing the December 31st, 2024 deadline. So, don't wait. Go grab it now at CryptoTaxAudit.com/1099. Sign your safe harbor allocation plan. Take your inventory snapshot on December 31st, 2024, and stash it for your records. Now, let's answer the questions you've been blowing up our inbox with. Number one, why will these new regulations cause massive disruption for taxpayers? These new regulations are the most significant change to crypto tax reporting since 2014. Here's why. All crypto taxpayers will be affected. The IRS will be automatically informed of all your crypto sales and transfers on U.S. exchanges. Reconciling data from 1099-DA forms will increase the complexity of preparing crypto gain calculations. The IRS will learn your wallet address involved in transactions with U.S. exchanges. The 1099-DA information will make it easier for the IRS to detect taxpayers not reporting all their crypto income. Taxpayers not reporting their crypto income will have a significant increase in risk. Moving on to question number 2. What happens if you don't adopt an allocation plan? If a taxpayer fails to adopt a safe harbor allocation plan by December 31st, 2024, the IRS will apply the FIFO by account basis method to calculating crypto gains, ignoring whatever method the taxpayer may have used in prior years. This could result in additional tax liabilities, penalties, and interest, which could be significant. All right, let's tackle question number 3. This is one that's been on a lot of minds. Why did the IRS issue this revenue procedure? The IRS issued Revenue Procedure 2024-28 to guide taxpayers' smooth transition to the FIFO by account basis accounting method. The procedure explains 2 ways taxpayers may allocate the unused basis of remaining assets to existing units of digital assets held within each wallet or account of the taxpayer as of January 1st, 2025. Coming in hot is question number 4. What is a list of unused cost basis on remaining assets at the end of 2024? This is a list of the original per-unit basis of a digital asset unit other than any unit previously identified and used. Accordingly, all units of digital asset basis held by the taxpayer as of January 1st, 2025, are treated as units of unused basis for purposes of the revenue procedure, even if the taxpayer can factually attribute some units of basis to specific units of digital assets. Some basis tracking online services allow the user to generate a year-end report of the unused basis. If the physical inventory doesn't match the unused basis inventory, corrections may be needed to adjust for missing transactions. All right, next question. Number 5. Is a copy of the Safe Harbor Plan given to the IRS? No, but if you are subject to an IRS examination or audit, they may request the plan and see proof that the plan was adopted by December 31st, 2024. Finally, question number 6. How do the new regulations affect tax return preparation? Digital asset investors will have additional complexity reporting their crypto-related income on their tax returns. They will still need to use basis tracking services like coin tracking to track the basis with these differences. 1. If you have a safe harbor allocation plan, you load the basis mapping spreadsheet like a set of manually entered transactions. Then load only wallet transactions starting from January 1st, 2025. Previously, you would have had to load all transactions from the past. This has the benefit of eliminating problems caused by incomplete historical records. 2. The transactions reported on the Form 1099-DA must be removed from the basis tracking service to avoid duplicate reporting. That's a wrap, legends. Don't forget to smash that subscribe button, hit the like, and turn on the notification bell if you're loving this alpha. And remember, don't wait for the IRS to catch you off guard. CryptoTaxAudit has your back with a free safe harbor plan to make this transition smooth and IRS compliant. No cost, no risk, full protection. Lock in your crypto values, get a clean slate for 2025, and avoid audit headaches. Go to CryptoTaxAudit.com/1099 to take control of your crypto taxes today. Thanks for watching. Drop your questions in the comments, and until next time, trade smart, prep smarter, and let's see those portfolios moon.